Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, May 2nd, 2024. It's 11:34 a.m. Eastern Time as I'm starting the video. What we're going to do is not cover the broad market in this one. I'm just going to mention again for the pretty much the final time. Apple takes it home tonight. Really, to me, it's kind of the official closeout of earnings season. Peak earnings is what I call it. Now, there's still plenty of companies to report. What I've done, I've always had the earnings dates up here on my calendar to the left here. I put it here more prominent. I saw a comment, somebody mentioned Carvana up big today, and they reported. You got to know, I said two things I always say when you're trading individual stocks. See, this is the benefit of indexes and sector ETFs. You don't have to worry as much because you're diversified, but individual stocks, especially during earnings season, you need to know when they report. So Apple's tonight. I've moved this over here. It's a little more prominent on my charts now. May 2nd. Today after the market closes. And again, that's there's certainly other companies to report. Again, I call it peak earnings, and this is where it tapers off. Nothing else really matters. Nothing else that's going to report other than NVIDIA. I'm sorry, coming up. NVIDIA used to not matter, and they here, where is that? I always double check this one too. This is TC2000's feed, checkearnings.com. Or even that I've noted to be wrong up until you get closer to earnings. So if you always want to know when they report, check the company's website. Go to the investor relations or stock information. They'll usually, or the press releases, they'll tell you. So we've got a couple weeks here before NVIDIA reports. And but Apple always was the big dog for many years. Largest, not just largest by market cap, also a crowd favorite. Earnings juggernaut, like most, does a great job of managing earnings. But I'm just showing you the weekly chart here. I know it's a busy board, but I wanted to mention again, which I have quite a bit, but not lately because it's already happened. We have that weekly PPO histogram clearly in bearish territory, meaning below the zero line, just like the S&P 500, just like the NASDAQ 100. And what that does here, I'll turn off all the lines. It helps to define the intermediate term trend because we're on a weekly chart here. So you see when it crossed right there, and it doesn't look like much because this is a weekly chart. I'm using log scaling, but that's a pretty good drop in Apple. And then you had red histogram there. So basically green tells you you're in a bull intermediate term trend is bullish, as it was throughout that period when the histogram was green. You had that run. And red is when the trend is bearish, right? Simple stuff. Let's not overthink it. If that flips back to bullish, then that's one thing. It's not a be all end all. You have a primary uptrend line here in purple that may get back tested. You also have on the daily chart, this is the I know it's kind of busy, but I've been highlighting you're in this range, just like the NASDAQ 100 was in a range bound. This one goes back even farther, much farther. So to me, it looks like a big topping pattern similar to what we saw in a lot of stocks and the market, including S&P 500, but IWM, you look at a weekly chart, a lot of things back in 2021 here. Let me park my histogram, give us a little more real estate here. Had these kind of ranges there, and you broke down, and even to a greater or lesser extent, the NASDAQ and the S&P 500 back here. You can see these ranges, and then you broke down. But so that's Apple. And again, just to summarize it, because they report tonight, and I'm not going to do another market video today. There's really no need. We're about flat on the indexes. Apple's, challenging that downtrend line now at the bottom of the range. And, it's a coin toss anytime you go into earnings, but I gave you my thoughts yesterday. Even though the daily chart, you have that divergent low positive divergence, and I can't dismiss that or ignore it. My guess, which meshes with my overall market analysis of where we're going, says that despite where we're trading tonight in the after hours or even tomorrow, maybe a run up to that 180 level, the 200-day moving averages, which we're below, based on the fact we have that red weekly histogram, the primary trend's bearish, and we're below the 200-day moving averages. I think ultimately, and that means we'll know by the end of next week probably the direction Apple's going to pick will be down, taking the market down with it and taking us down to my next targets on QQQ. Okay, now here's what we're going to do in this video. I'll give you a little bit more, but than I wanted to there. on the markets in Apple. But again, I'd be remiss not to, talk about this today because so the market's going to probably be in a holding period today, waiting to see what Apple does, and then we should have a good idea next week, maybe even tomorrow, which way we're going to go. All right, let's go to, here's what we're going to do in this video. We're going to update commodities. I'm going to try to get them all at once. It won't be super long because I'm not going to go over every single commodity. I'm going to go over the ones I've been highlighting recently, and we're going to do it in this order. We're going to cover the grains. I got a post out to you this morning on soybeans. I've been providing fairly frequent updates on wheat, semi-regular updates on corn. And again, these are the three big grains. As I mentioned, there used to be JJG for years. We'd be able to trade. I could give you, when I was bullish on all, like I said, birds of a feather tend to flock together. These are, you can use corn or wheat interchangeably. Go into your favorite Mexican restaurant where they ask when you ordered fajitas, do you want the corn or the wheat tortilla shells? They're almost interchangeably. So what happens if corn skyrockets and goes up, has a 100% increase in price, and wheat stays cheap, everyone's going to just start using wheat. So wheat's going to, they tend to follow each other. Plus, keep in mind they're both grown in temperate climates. So it's not like coffee, which is grown in tropical warm climates in different places around the world. So they have different weather and crop issues. So there it is. So, and JJG's gone. Like a lot of these, IPATH retired a lot of these ETNs they had back last year. And so you used to be able to kill three birds with one stone there, wheat, corn, and soybean in one. So I'm going to just go over those. Won't go into super detail. I mentioned recently we hit T1, pulled back as expected. This is how, this is why multiple price targets are listed. Upon the initial tag of each one, we had the breakout of the downtrend line, the back test, a reaction's likely, and we'll still maintain these additional targets. Therefore, you can buy even right now, pull back to there's no support here on this chart, but when you go down to a 60-minute chart, you do have minor support here. And bottom line, the long-term chart still looks constructive. Now, I mentioned, by the way, in that post this morning, again, I know that I sometimes have to remind myself, new people coming into the site or existing members maybe that disengaged the markets for a while and are getting back in. I've made the case many times over that a lot of these, just about all commodities, bottomed when COVID hit, really, and the markets bottomed in 2020. And that includes wheat, corn, soybean. Wheat had a deeper correction than most, but it still came back. Remember, this is the ETN, not the actual futures. The futures, they do, I cover these because I know this from doing this long enough. Most of you don't trade futures. So I try to cover these ETNs for you. The futures are more of a pure play. That tends to be what the pros are trading. And these ETNs are doing their best. You're using futures to track the price, but they have additional expenses and fees to roll the futures and do all that good stuff. So at least it's not leveraged, and it does a pretty good job of tracking. And so you can see here on this weekly chart, we had the primary secular, bear market downtrend line coming into the lows there. We had a breakout, back test 1, back test 2, and that's all she wrote. And then some of the case that I've made, and you can look at a broad-based commodity ETF like DJP. It's been around for a long time, and this has everything in there: gold, crude oil, natural gas, agricultural commodities, industrial metals. This is, again, it tracks the UBS commodity index, so it's broad-based, and it's going to show you what they all have almost the same charts. They were in a bear market until 2020, and then what happened is they took out the primary downtrend line here. That in itself is pretty decent evidence that the new bull market is underway and a bear market's over. But then when you started taking out, which it clearly did, all the previous reaction highs, that tells me, again, the case I've been maintaining for quite a while, this was an initial leg up in a new bear market with a corrective wave. You can see here, as I've covered, it went back down to about the 50% Fibonacci, a little less than that. So I view this as the first corrective wave in a new bull market with more upside to come. That also factors into my outlook for the markets going forward with persistent sticky inflation, maybe stagflation, we'll see. But we know that interest rates, are certainly up, and and nowhere near, and probably never going to go back down to where they were. So I do like commodities. And if nothing else, I say this all the time, for diversification. Diversification doesn't mean have 5 or 10 stocks in your portfolio. If they're all Apple, Amazon, Microsoft, and Meta, you have no overlap. You're not diversified. You're basically in the same trade because they go up and down together for the most part. Diversification means to have in your equity portion different sectors, uncorrelated sectors, and also stocks are one asset class. Then you have fixed income, i.e. bonds, and within there you have corporates, government bonds, municipals, whatever you want, different subclasses, and then commodities. Now, commodities is a big pie too, as I mentioned. It got out to you in that post this morning. You have all commodities that have absolutely no correlation to one another. You have industrial commodities, steel and aluminum. You have precious metals. You have agricultural commodities. Even within ag commodities, you have the softs and the hards. Softs, you have things that grow out of the ground. Then you have livestock, all different stuff there too. And at any point in time, one's going up and the other may be going down. So these are, the main pillars of diversification, or what we call asset allocation: stocks, bonds, commodities, cash, if you want to consider that one. But either way, I just wanted to get on that, and I'm not going to go over each and every. I'm going to go over the ones that I've been highlighting lately that seem to have the best RR, or risk reward profile. And so this is that weekly chart, and there it is. We broke out. We rallied in. This is a level I've had here forever and a day. I created that back in 2020. You can see the pop-up box. I haven't even touched that line since back in 2020. I created it in March, and so it's been a level. To me, it was a big level. It was support, 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 support. We had that final washout move, and then that beautiful basing pattern. And this is where I started getting longer term bullish on all these commodities, including wheat, which we're looking at here. Breakout, back test, and boom, off to the races. Initial leg up, ended in a buying climax because of the Russia invasion into Ukraine, one of the world's largest wheat producers. And buying climaxes tend to have pretty, when you get it, they tend to be pretty powerful on the downside. Either way, we still maintained above the previous lows. And to me, again, nice RR. You have that beautiful downtrend line breakout. And again, the breakout wasn't random coincidence where it stopped last week. 596 is what I have it on wheat. You want to, also keep an eye on futures, which is what I do. And so we'll call it about $6. So when we punch that, we should be off to the races. That should open the door to these next longer-term swing targets on the weekly chart here. You can see, again, 596 was also my level, and clear resistance on this daily chart as well. So same story, guys. Let's not beat a dead horse here. So far, everything I see is constructive and indicative of a possible bottom in wheat. This is also a long-term trade idea. On the side, I categorize swing trades as long or short swing trades, but I also have a subcategory called long-term trade ideas, meaning this is one that I think you could hold on to in longer-term account, IRA type of stuff, and not even. If you're an active trader, sure, why not, game a little pullback off the first target. But if a swing trader investor can hold out for the prize. And again, let's not forget, if my read's correct, and this is, we're in the initial leg up of a new bull market in commodities, then the upside is quite a bit. So here's corn. I'm going to now go over to corn. And you can see, because corn didn't have the blow off top, wheat seemed to be the big thing when during the invasion of Ukraine. But you had big divergent high there. Same thing, downtrend line. I had two trend lines, both of which were taken out. Big divergent low back in 2020. Initial leg up, corrective wave, typical retracement. And so, over time, corn looks good. That's the weekly chart. We go down to the daily chart. You've got corn popping above that 2020. Last update I gave you was in here somewhere about a week or two ago, and said next buy signal will come on a break of 2020. It's not ripping, and I also gave you at the same time the chart of the futures. So we need to look at that. Okay, guys, this is why I post both. Well, for futures traders, I know some are ETF traders, some, but also this is what's driving it. So while we did take out that level, I said would trigger the next buy signal on the ETN. This is the more important of the two because again, the ETN's tracking these. So watch futures, whether you have a futures account or not. Free charts from most brokers and or investing.com. And so you have this beautiful little trading range right here. And you can see that, that's 457 and a half. So we'll call it 458. Corn needs to pop that. This is a 1 year chart using 4-hour candles. So instead of a daily candle, they're every 4-hour period. It's just sorry, what I picked here. And that's it. So that's why, in my opinion, even though corn popped that level, the ETN, CORN, until we pop it here, this is what matters. And then that's why I said you might want to wait for a solid break above 458. And then there's your all potential targets for you, which I already posted that chart today for you ETN traders. All right, next up, again, one of the third big grain, soybeans, breakout back test right there. So that looks good in itself. Oh guys, it just hit me. This is the one I got. I took the screenshot for corn today, and I was going to follow up with a static chart on that. I forgot that I only got soybeans out to you. Again, I screenshotted corn as well, the charts of the ETN and the futures, but this is the one I got out to you. So, but what I just said in corn holds true. You want to, the same law, I was going to say the same thing. You need to, and it's not too late. We're at that resistance level on the futures. So this is SOYB. So on that, it broke out, back tested here, T1, T2, T3. You can see the targets there. That would take you to the top of this trading range. This is a daily chart. Now you look at a weekly chart and see soybeans were strong off the initial run. There was their bear market, ended in 2020 with COVID and the stock market. That's when the government, both the Fed and DC, flooded the U.S. economy with fiscal and monetary stimulus, which set everything on fire, including commodities. The Fed thought they could play the easy money game forever, and finally it caught up in the form of inflation with exploding commodity prices, including and especially crude oil and the things that matter the most. But what you see is a high-level trading range, maybe a topping pattern, possibly, I don't know. You've got some negative divergence. You can certainly make that case. But like I said, with corn and wheat setting up pretty nice, this could just be high-level consolidation with a breakout above. So either way, what I can tell you definitively is that we are at the bottom of that trading range, about 2460. There's been a few brief punches below, but we regained it each week. Those were just weekly breaks, and it's above that major reaction high. So this is TA 101, guys. Like I said, I can't guarantee anything, whether this is going to break out, whether it's going to go up. But what I can guarantee you is it's at support. So there's two ways to objectively go long, make a case to buy a stock or an ETF or a commodity. You either buy a breakout above resistance or you buy a pullback to support. So this is at support. It's also at the bottom of a pretty wide trading range. The top of the range is there. So you buy it with a stop somewhat below the recent lows, right? And even if it's just going to be range bound for a while, you got about 16% to the upside of the range. And again, you're going with something that has absolutely no correlation to the stock market or bonds or probably most of your other holdings there. So that's soybeans. Let me give you the futures. Okay, so just like corn, you can see it's got nice resistance. You had this little right here trading range, a little basing pattern. You can see that was resistance, the same level we're at now. I called it 190. It says 191 3/4, so we'll just call that 192. We'll round up. A little kind of W bottom there. We broke out. We rallied pretty good. Came back down. Resistance once broken, access support, 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 and then we gave away support. Then once broken becomes resistance. It's simple stuff, right? This is really easy. Simple, clear chart to me. Very, very clear support level, about 1155. And we took out the downtrend line. I had excluded one little spike there, but other than that, we've one, two, count that, three, multiple reactions on there, at least 7, 8. When you come down here, we pop the trend line, but like I said, you want to give it the what I call the BOD, or benefit of the doubt. So with just a little more upside, pop through 192, it should run up here. There's your targets, about 1211, 1226, 1243, 1267, and maybe more. I might add some additional ones if this thing gets going on, but I can see that we had to, that was support back there, and then we broke down impulsively. So that'd be a uppermost target for right now. All right, so that's what the futures look like. All right, let's flip over to energy now. I'm going to start with the one that, one of well, there's two. I'm sorry, energy, let's keep it simple. Natural gas and crude oil. So we have UNG, again, is the ETN, does an okay job, as good as anything. Once in a while I'll see, some criticism of these ETNs on the site. And I get it. Look, guys, if you don't trade futures, you don't have a choice. Either don't trade these ETNs if you don't like them, because they don't do a perfect job. Overall, you get you catch the trends, UNG and USO for crude oil. They do a pretty darn good job, just like wheat. And again, it's better than nothing. If you have a futures account, great, trade the futures. But that's it. Other than that, go buy a silo and put it in the back of your barn and store wheat, and then try to sell. There's no other way to trade it. So cover these ETNs, and you guys decide if you want to trade them and how. So this one seems to be basing here. This is you can see these divergences. We've had these. We hit T1, we hit it again. We need to now take out, go and hit T2 and take it out, and then natural gas should start running. Remember, it's at long-term support, and it's not shown here because UNG over time, you're going to see this one continue to lose. Here, let me pull up. I keep talking about it. I haven't covered it in a few weeks. Let me log in and I'll show you the long-term chart of natural gas I'm talking. Okay, this is nat gas, weekly chart. We're going back. You could just make it out on the bottom. This is the start of 2010. So we're going back to 09. And in recent years, this is 2016 low right here. And this is 2020 where we bottomed, and this is 2024 where we bottomed. So you can see we're at the low end of the range. There is no hard bottom. I guess 0 would be the bottom, but we're not going to go to 0. That means they're giving away natural gas for free, right? And it's not going to happen. Crude did go negative during COVID due to storage issues. Now the futures went negative, and that's just because they had nowhere to store, and it was very brief. But again, that didn't happen in nat gas. So, because unlike, crude, nat gas is pipelined, and crude you've got to put up in the big vats and, storage facilities. So there it is. You have big divergence at long-term support, strong positive divergence to me. And I know the seasonality isn't here per se, but then again, it wasn't back here either. That you can see the same time of the year back here heading into May. Looked like right there about. That's when it started to explode and had that big run. Yes, a lot of that had to do with Ukraine's invasion, Russia's invasion of Ukraine. But either way, you can see the technical case. In the technical case was there as well. It wasn't random. You had positive divergence at long-term support, and boom, it exploded. So that's it. So it's kind of grinding out a bottom, and you can see here too. That's where what I was trying to show you, where natural gas doesn't do, or UNG doesn't do a perfect job. I'm going to move that divergence line. It's bothering me. It's not clean right there. But you can see that nat gas has clearly come off the low of about 150, and that's where I last highlighted here at long-term support. So it's pretty much been a longer-term swing trade or trend trade idea since then, and it's up, I don't know, 50 cents on $1.50. That's almost 33%, or about 30% or so off that low. And that's, again, the futures there. Oh, and if I didn't say it, it's obvious, where does it go? You look for, big divergent, even any divergent low on the weekly. Remember, we're looking at a weekly chart. This is a long-term chart, weekly candles. Minimum up here, then there. These are the first two. That was a support resistance zone. So that would take us up to about a little north of 350 or so, probably around that reaction high, somewhere in that zone there, from about 330 to about 360. Maybe get a reaction there, maybe not. Natural gas, I always say is a trendy little sucker. It has been consolidating lately, and it will do that from time to time for a little while, but not for long. By calling it a trendy sucker, this thing's usually full throttle up or full throttle down. Once in a while, you do get in these ranges, and they can last for a while. But even within the range, the volatility is so high. If you can get in and out quickly, you can trade it and make a few bucks. So it hasn't really taken off yet, but setting up, I believe. Here's NG futures on a different version. This is right here, the current contract, the Junes. Here's a downtrend line off the highs. This chart is 1 year price history. So you can see we had this trading range. It was big support right here. That support broke, put us in this downtrend. 8-hour candlesticks. So, when does it rip? Well, break of the downtrend line, and then especially the BOD, benefit of the doubt level, about 213 and a half is where I have that horizontal resistance level. So whether it breaks out, hits that back test or not, a breakout above the trend line is, one buy signal. But again, you have 213 in close proximity. So that's what I call the BOD, or benefit of the doubt level. Take that out, and that gas should rip, in my opinion. And by the way, I use these terms rip, and I show you the, this thing, like when it runs, it just really runs, and fewer things can put more money in your pocket in short order. If it goes all the way back to $3, that's about a 56% run from where we are. But on the flip side, fewer things that you'll trade can take money out of your pocket faster. So the thing is, I'm making the case. I'm showing you long-term support. I'm showing you divergences, trend lines that could trigger buy signals or additional, bullish events. Don't get married to natural gas. Number one, don't fall in love with it. It'll freaking hurt you. I call it the widowmaker. And then number two, beta adjust your position size. You don't need to put a lot. If you're targeting a 50+% move, you don't have to put as much in as you would put into SPY or treasury bonds. You put a lot less, because that allows you to use wider stops, which you need. If you run tight stops on natural gas, they're going to take it from you. A 5% trailing stop, that's just noise within, the daily grinds of this thing. But, like I said, charts are constructive, and you have the levels that, if taken out, should really start to bring in some buyers, and could have this rip. Other than that, we remain in that trading range for now. Crude oil, I've got tons, probably a dozen different charts. This is one, it's a daily chart of the futures. We had this trading range back here, and then you broke that trading range, that support level, the bottom, which is this red line here. I have it set here. When you're above it, it turns green. It's support. When you're below it, red is resistance. Rejected there, rejected there. Been a little sloppy from here. You had a break above it, then a failure, but then a rip back above, took you back to the top and even above the top of the trading range. Crude has been volatile, but you can see it's still, despite a couple breakdowns here, positive divergence, it's still at the above that bottom of the range, or actually right down to it right now, which is still support. Like I said, when you start to get sliced through, it makes that support a little less valid, in my opinion. But again, you can kind of see bigger picture. Remember, crude prices remain elevated. The chart I've been showing you forever and a day now has been USO, and I color-coded the zones. And this is a great example too. I'm not sure. I'm not hearing a lot on the site, so I imagine not many took it. But when we're kissing the red zone, and right below here in the orange zone, in the middle to upper part of the orange zone. Remember, red zone, it's not random. It's it's at resistance, and that's where we hit. And I said at this point, because we've been short the Q since then, I said you can take a short on USO. It's getting a little lofty. It's at resistance or coming up to resistance. And you can have an indirect hedge, just like the TLT or ZB, the treasury bond trade, long treasuries. But I said go short crude, because falling crude prices should be net bullish for equities. However, that's also based on the charts and all that. And so if you're lucky with these indirect hedges, then both pan out. So if you did short crude up there around that the bottom of the red zone, you're already up 9%, and you're actually profitable over that time on the QQQ short. So that's another example of how these indirect hedges could short. Now, where to look? Obviously, yellow zone's the first support I have marked here on the daily chart. And maybe we're going down there. You can see we broke the uptrend line. But I suspect we're getting there. I can't make a strong case because I don't have divergence and I don't have a solid support level, but I do have some support here. You can see it was support back here. These were targets. We shorted crude back here, swung it down to that third and final potential target. Then must have reversed it because I had two bounce targets there, hit T2. But you can see it danced around that level. And so we went carry it through here. It was resistance, 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 boom, breakout. And we're coming up on support. So here's what I see, guys. I see limited downside in crude from anywhere from right here, about 75, down to this uptrend line right here on USO. And that's not much. So you could start, if you did, anybody that has been shorted, and remember, it was also based off the technicals. As I said earlier, we had a divergent high, just like we had a divergent high there. It was a catalyst for that short, negative divergence on the 60-minute chart. Then we broke the trend line. We back tested it twice, rejected, and so that's it. So just like then, I think we've either come full circle or most of the way there. And so I see, again, limited downside before a decent tradable bounce, about 2%. So you could start scaling in here, cover your short, go long, or start a position and add to, but not below that level there. And you've got some price support down below. So I think crude, and you can see we don't have, which I like to see, positive divergence. There was the last big divergent low on the 60-minute chart right here. And you can see what we got out of that divergent low. These are what, signals trend changes. Divergent high right here, divergent low, divergent high. And so that would be, a potential target. However, so we don't have the divergence, but what we do have is an extreme oversold condition. Let's just circle. You can see well below the the 30 level on the RSI, which is denotes overbought, oversold. The last time we were this oversold was right here, and you can see what happened. The time before that, we weren't as deeply oversold as we are now, but we were right there. And so you can replicate this on your own chart. So you tend to get, especially in bull trends, when you get oversold, it's usually a gift time to cover shorts and or go long. So that's that. Unless this is a major top in crude. If crude continues down much lower and keeps falling, again, there's plenty of room. We're much closer to, we're still in that yellow zone. And there's the bottom of the yellow zone. I just showed you a minute ago support on the 60-minute chart, which coincides with that 74 support, which is the bottom of my yellow zone as well. So that's it, guys. And so the case can be made to start scaling in now. You could hold out for it, but a lot of eyes are going to be on there, and crude will probably get gobbled up before you get too close. Maybe, maybe not. So there's your update on crude oil. I already gave you natural gas, so that's your energies. And now let's go into the final. I'll cover the precious metals. Somebody asked for an update on platinum and palladium. I'll be glad to give that here. This is gold daily chart. Let's look at the weekly chart. That's what stands out to me. Going back all the way here, I'm going to shrink this down a little bit to give us a little more real estate on price. You had this big bull market blow off top. By blow off top, what am I talking about? You can see gold was in an uptrend and finally went vertical at the end with a big buying climax. You probably can't make it out. I have my volume bars turned down, but the volume was averaging about here, and then you had a surge right there, and that's what that's indicative of a buying climax, and it was, meaning that's it. Everyone that just kind of like Nvidia is probably going through now. Everyone that chasing the rally at the end. People just, gold's going up, up, up. It won't go down. It's not letting me in on pullbacks. And then they chase it, and that's usually the end. I'm going to get back to gold. Same thing I see happening right now on SMCI, which is a short trade on the site. And they've already reported. They reported, was it yesterday? And so you can see when you look at the chart, well, I keep saying you can see. Maybe you can't see. I'll turn it up for you. There's your volume. This is what a buying climax. This is a textbook buying climax. There's a guarantee that was a buying climax? No, but this is what technical recognizing. You can see the volume ramping up and then a vertical run with a big surge. So, that's still, my sole swing target down there around 228 has been since we shorted it back here initially right there. And I give a couple other short entry points. Even covered it and bounced it recently. But then back in, as I told you. And then the primary uptrend line right here is probably where we're going to go, because parabolic or blow off tops typically are major, they mark major turns. And so again, that's kind of, if you just look in trend trade, probably something like this, and then ultimately down to that trend line there. So I'm just wanted to use that illustration of what a blow off top looks like. And then again on gold, you can see it here. You can see that volume surge into that. There it is now that I have the volume bars turned up. You can see a little better. Okay, so where we're at. So we went, through that was the top in gold. Tried to break out here, had a failed breakout that sent gold lower. It's been consolidating. That was a powerful breakout to new highs, and then a lot of buying. Not as much, surprisingly, not as much buying coming in as back then, but nonetheless, you can see here we had a buying climax right there, and it was a failed breakout. Intra-week break, couldn't hold. That was also a buying climax, and both times, it sent the stock down for months. Now we do have a volume surge on this breakout, and we do have very big negative divergence. So while I used to be very longer term bullish gold, I'm a little more cautious. Here's my take. I'm just going to tell you my take. I think it's dead money for a while. I've thrown out some short trades if you wanted to game pullbacks, but I think it's probably going to grind around. Ultimately, I think come back and back test the breakout point. Really, those. Right now, I'd put the line. Come here. I'm going to give it to you right now because the line should be right here, because we had a few false starts above it. This is your breakout point. I'm going to color it up purple. That's our big level. That would be a full back test. Why did I move it there, even though the previous one? Because we had that failed breakout there, one there. There's a candlestick high there, almost there, and right there we had several. So about 193 if we want to come in and back test. What would that mean for gold from where we're at now? Well, from the highs recently, means it would have to come back in about 14%. Could it keep going? Sure. It was a pretty powerful trading range here, but again, got some divergence there on the weekly chart, which means that breakout could ultimately fail. We kind of got really bullish in gold. There was all that noise in the media about Costco selling out all their they were selling gold coins, and making a ton at doing it. I almost bought some, but I was back before it even broke out. I wouldn't chase now. I'm just saying that, again, this, it's been, since the initial surge, they've been fading the breakout. So I don't have a strong conviction on where gold goes. We look at the 60-minute chart. I've been updating that. I know I get a lot of inquiries about it. We had a series uptrend line there. Breakdown back test right there with a divergent high, objective, impulsive selling. Secondary trend line, we gapped down below, and the third trend line, we back tested, and we're still below it. So positive divergence on the RSI, but I'm sorry, the PPO right here, when you look at this point here, but not on the RSI. Although we are oversold, and the trend is bullish. Last time we were this oversold was right there. So again, that's why I'm kind of showing you a mixed bag. GDX, pulled back. We put in the same thing, a little kind of blow off top, divergent high. S1 first support took out. S2 was a trend line. S3 was hit, and then it was hit again. We bounced. It's just, see guys, it's dead money, and that's why I'm not posting as many updates. Same thing with platinum and palladium. We'll start with palladium. Somebody asked about it. Let's go to a daily chart. This is palladium. We put in a divergent low back here on the daily. It's been moving up, but for the most part, it's in this big, if you look here really on these recent highs, that right there, there, and there, and there was support right here, support under these candles, resistance. So you had one little failed breakout above it. Other than that, it's pretty well defined. So it's in this trading range, and we had one false breakout below. So that bottom, the way I boxed it in here, is defined by a lot of reactions on the downside. So we're at the bottom of that range. You can make a case to go long. I just don't have a strong opinion, strong convictions on it. This is what it looks like on the 60-minute chart. You can certainly get in front of these turns with the trading these divergence. I didn't have it marked here because I haven't covered it in a while, but we had a divergent high right there. Take that, put it right there, show you the divergence lines. And that's it. So you can see it's really going nowhere. And that's how, I'll always do chart requests. People ask for updates, but, typically, not always. Sometimes I miss things. I'm just not watching them. They fall off my radar. But in this case, it just is bigger picture. It's going nowhere. It's choppy. It's grinding around. So that's why, hence, not a lot of updates. PPLT is the platinum ETF. So talk about a grind. This is going back until last summer. This is almost a year long here. This is a 60-minute chart. It's not super well defined, but for the most part, you can box it in here and see that this is it. And this thing is either going up or down, up or down. You can draw little trend lines. A lot of times it's these trend line breaks. And the divergences, if you look at my chart, you can see I have divergences marked up. So, you can sit there and trade off these divergent lows and highs, especially if you can coincide it with a trend line break. So that was, oh, no, that divergence line should be from right here. You can see I had the divergence drawn on the RSI and PPO. So that was a divergent low rally, bigger divergent low, rally, big divergent high correction. Yeah, I think you can see where I'm at. Divergent high correction, divergent low there. There's a case we had divergent low, a little false start. The divergence got bigger, and you got this rally. Most recently, you put in a divergent high. So that's it, guys. And on the daily chart, this is what it looks like. So it's really, this is why you're not getting a lot of updates. But again, I don't mind giving these. This means island cluster, island top, not island cluster. That was an island top, one single island. You have a candlestick, a little doji candle separated by gaps on both sides. And those are major reversal patterns. That was a divergent high there. That was a divergent low. It's not written, but see my divergence line. So, and it's walking its way up this uptrend line. So there's your update for platinum. If you can catch these zigs and zags, great. Little small divergence right now. Nothing big, but maybe that ends this rally here and sends it back down. Okay, guys, that's it. 41 minutes, and I'm just going to whip over to one more thing before I leave, because I think we have a breakout now on soybeans. Yeah. So remember, that's the 191. This is the one I got out to you today because it looked ripe to pop. So there it is. So you took out in one fell swoop the downtrend line. And now you're above that 191 and 3/4, call it 192 level. And so that looks good. And because of that, most likely, whether it's right away or not, corn and wheat will likely follow. So I do like spreading the bets on those. All three look constructive. And so, as I said earlier, you never know which one's going to be the winner out of them. And so, you can certainly overweight your favorite, but it's just, again, another way to diversify. No guarantees, but set your stops accordingly. If the breakout fails, especially if you go back below the trend line, then you're probably going to visit those lows, maybe even punch down and make another divergent low. Wheat was doing that for a while. Kept trying to run, pull back, retest the lows, even undercut them slightly, and but still looks very constructive. Both of these do. So, all right, just wanted to get that out to you. This has been Randy Finney with Right Side of the Chart. Have a great day.